It's been 14 years since I first started working in the asset management industry, and this is what I've learned. This in no way means I'm an expert or that I know what's going to happen next, but I have built up a pretty good idea about how markets work. So today I want to share some of the best wisdom that I've picked up along the way. Although I owe a lot of the knowledge I've gained to working in the industry, I never really got on with the corporate world. That's a story for another time, but when I was younger, I saw investing as a way out. I was willing to take risks in pursuit of a goal because I was young, but that snowballed into taking bigger and bigger risks, including borrowing money to invest. I was so emotionally driven, I was investing for all the wrong reasons. I was essentially trading or even gambling. If I had a few winners back to back, I would get complacent and either take bigger and riskier bets going forward, or I would go out and spend that money because I thought I could replicate that every month. Or if I had a few losers, I wanted to win that back straight away, what's known as revenge trading. But by chasing quick results, all I was actually doing was slowing down my progress long term. During World War II, the Allies analysed damage from aeroplanes coming back from battle. And this analysis of the damages resulted in this idea that the aeroplane should be reinforced in the areas of the aeroplane showing the densest clusters of red dots. However, a statistician by the name of Abraham Wall didn't agree. He actually suggested that the aeroplane should be reinforced where there was no indication of damage. He was of course right. By only studying the planes that got home, the red dots actually represented non-fatal areas. If there was a way to analyse the planes that didn't make it home, it would likely show an inverse pattern. There is an element of this in analysing companies, especially in an index, where it's only showing the companies that actually survived. But here I'm more referring to that feeling that it feels like everyone is winning and everyone's making money in the markets. And I think social media has a big part to play here. We likely only hear about the winners, the ones that make it big. We don't always hear about the ones that lose money investing. And that gives us FOMO because we feel like we're the only ones potentially not making any money. It's the same on Instagram, where everyone's only showing their highlight reels. It makes it seem like their life is amazing, but they don't show the behind the scenes because it's not that exciting. But it makes it feel like that's what they're doing all the time. And it can be similar with investing. How many times have we seen it where we've seen these stories of people holding companies for long periods of time? So they bought Amazon in the early 2000s, or they got into Bitcoin when it first came out. On paper, and of course in hindsight, it sometimes feels quite simple. You've just held throughout that period, you would have just forgotten about it. But you would have forgotten about all the peaks and troughs, the volatility that they would have had to ridden that through. And this makes it feel like some of these risky strategies are more normal than they really should be. We've seen it in gold and other precious metals more recently, where they've been on this massive rally in the last year or so. And there is an element of FOMO here. Because we see these people making lots of money, we feel like we don't want to miss out on that. But there would also be people who have lost money in this time frame. Either people trying to time the top and short the market, or even if they're betting in the right direction, they would have traded it and used leverage. And because it's so volatile, they may have still lost out, but you don't hear about those stories. So if you jumped in for the wrong reasons and potentially a little bit late, within the last couple of weeks, we saw gold drop by over 20% in less than a week. And that can be a really hard lesson to learn just because we weren't looking in the right places. You can invest into the right technology, but just at the wrong time. And you won't always know that until you have hindsight. Think the internet and investing into it in the late 90s and early noughties. It was the right technology of the future, but it was just the wrong time to invest. It was too early. It was in its infancy. It needed time to develop. Hence, everyone got so excited and we had crazy market valuations, and then we had the dot-com crash. It could be the same with blockchain technology. When most people hear the term blockchain, they immediately think cryptocurrency, but that's actually just one use case for the technology. It's got so many more possibilities, but we might not see these come to fruition for the next decade or two. And it could be the similar thing with AI. It's likely that AI is going to be the technology of the future, just like the internet was. But this potentially could be the wrong time. Everyone's getting excited, valuations are starting to get a bit out of control. And there could be a dip, a crash, a correction of some sort. But actually the real gains will be in the 2030s or the 2040s. But we just don't know where, when, and what they will actually look like. The point I'm making here is that the winner in a particular decade is unlikely going to be the winner in subsequent decades. Themes can perform well for long periods of time, but there'll be other themes that come to the forefront that won't be so obvious. And the issue here is this short-termism, where we feel that what's winning right now is also going to be the winner in the next 10, 20, 30 years' time. I think this graph is always interesting to look at when we talk about market cycles, because this is looking at the time periods where the US is either outperforming or underperforming the rest of the world. And I get this sense that there's a feeling, especially amongst younger investors, that the US has always outperformed the rest of the world. But that's mainly because they've only been investing since 2010. And what this aims to highlight is how cyclical the market can be. And it's unlikely that a specific area, region, or sector outperforms for such an extended period of time, because at some point things will get overvalued and people will start looking for value and opportunities elsewhere. On a 5-year monthly rolling returns basis, it's now coming up to 15 years that the US has outperformed the rest of the world. And a lot of people are looking at this and suggesting that it's now time for a change. This in itself doesn't necessarily mean that the US is suddenly going to underperform, but it does highlight that we've had this extended period of time of outperformance, and opportunities will be elsewhere. So the main takeaway from this point is don't look at too short a time frame. Always zoom out if you're in doubt. These are some of the biggest mistakes I see on a regular basis. Most investors have far too many funds these days, and a lot of them don't even know the real reason why they invested. They treat investing into funds the same way that you might treat investing into individual companies. We're taught that we need to be diversified in investing. We need to hold stocks in different regions, sectors, and countries. And that carries through into ETF investing. It feels far too simple just to hold one global ETF. So we start layering all these other options. And before we know it, we've got a portfolio of more than 10 different ETFs. It's very unlikely you can have a portfolio of 10 plus ETFs that has no overlap. Overlapping in itself isn't necessarily a bad thing because it can be intentional. But for a lot of investors, they don't even realize they're overexposing themselves to specific companies, regions, or sectors. A really popular example is using a global ETF and the S&P 500, two very popular options, and because people can't choose between them, they invest into both. And in a global ETF, because the US is so big, it already makes up about 60% of the global economy. And if you invest into 50-50, that would be like going from 60% weighting to an 80% weighting. Again, that could be intentional, but it's unlikely because you've already got such a big weighting to the US. If you really want to simplify your investing, I have a free ETF cheat sheet that you can download. It breaks down the most popular ETFs in different regions and different sectors, makes it easy to compare. It's the top link in the description below. When it comes to fees, I'm going to say something that most content creators don't say, and that's that I think so many investors focus far too much on the ongoing charge for an ETF. It's an important consideration for sure, but it shouldn't be the sole reason for choosing an ETF. When comparing global ETFs, the difference sometimes is as little as 3 basis points. You'll see much bigger differences in both the spread, the tracking accuracy, and of course the type of index that it actually tracks. This is looking at 3 popular global ETFs from Invesco, State Street, and Amundi. You've got Invesco at 0.15%, you've got SPDR, which is State Street, at 0.12%, and then Amundi at 0.07%. But when you look at the performance figures, which are net of the charges, the Invesco fund is actually the winner. That of course doesn't mean the Invesco fund is always going to beat these two, but it does highlight that you can't just focus simply on the ongoing charge. The fees you really need to worry about are platform fees, whether they charge you an annual management fee or FX fees or dealing fees. Those are the fees that are really going to eat into your returns. Some platform fees can be as high as 1%. And if you took that one step further and actually got advice from a financial advisor, they could even charge you 1.5 or 2%, which is just absolutely insane. Timelines are so important with investing. It's important that you split out your investments into different time frames. So you've got some that cover your short term. That might be an emergency fund. It might be a separate savings pot if you're saving for a holiday or a house deposit. Maybe you've got some medium term savings or investments. And then you've got your long term stuff. The stuff you can be a little bit more risky per se. You can ride out some volatility. And when you split out your investments like this, you can have much more structure. So when you're trying to choose your investment and you look at what someone else is doing, you can then think, where would this fit in the structure of my portfolio? Rather than just picking something because someone else has picked it and think, oh, this is a good investment, but not really knowing, is this something I hold for 1 or 2 years, or is this a 10-year plus project? Goals follow on from this because it's so important to lay out exactly what you want from your investments. Be really specific and be really clear here. Say, for example, you set a goal of wanting £1 million in your pension pot by the time you get to retirement age. Once you've set that goal, you can then work back and decide what behaviors you need to implement to hit that goal. So it could be a monetary amount that you need to invest per month. If that's the case, then what does that look like on a monthly basis once you get paid? Paying yourself first. So that's the fixed amount and then everything else is variable. That's the priority. And that's the behaviors that you need to implement. So rather than focusing on the actual number, you focus on the behaviors that get you towards that goal. But you have to have that goal in the first place. The big rewards with investing is why people take risks in the first place. But the mantra that the more that you put in, the more you get out doesn't always work with investing. And in a lot of cases, it can actually make it worse. Whether that's over trading, you're tinkering too much, and you're just trying to time the market, likely will make your returns worse. Picking stocks is inherently risky, and that's why most active fund managers don't beat their benchmarks over long periods of time. But it does differ from different regions. For example, in North America, over a 10-year period, only 15% of active fund managers actually beat their benchmark. Compare that to global emerging markets, where 56% beat their benchmarks. Now, a lot of that could be down to the size of the market, the accessibility, the amount of information available, and just the number of people trading those markets. And what that suggests is that there's potentially more opportunities in some of those smaller and emerging markets. Yet when you think about it from a retail investor's perspective, they're not putting the time into researching those emerging companies. They're going to stick with the big markets, like the US, for example. They're going to be picking Nvidia and Tesla, not the emerging markets that have got more opportunity. What this data says to me that if you want exposure to countries like the US, you're better off just using a passive ETF. But if you want to have some active plays in your portfolio, you're better off looking at other areas of the world. Even the UK at 31%, less than a third beating their benchmarks, but it's still double that of the US. And a trap that a lot of investors fall into, especially younger investors, is because they haven't experienced a loss in the markets basically since 2008. So since they've been investing, they haven't really experienced anything dramatic. We've seen a few in the last few years. Last year, we had the fallout from the tariffs. 2022 was the fallout from the pandemic. And 2020 itself was the reaction to the lockdowns. But they all recovered very quickly. And we've seen some massive bull markets in between. And sometimes until you've experienced a loss, you'll be willing to take more risk because you don't know what that actually looks like in reality. You can read about it, but until you actually experience that with your own portfolio, you'll likely take more risks than someone who's been around that's potentially experienced. Especially in the last 25 years, we've had both the dot-com and the global credit crisis. And that, of course, will just come with experience, but it does reinforce also the point we made earlier that what's winning in one particular decade doesn't necessarily mean it's always going to continue or it's going to be the winner next decade. One of my biggest frustrations in the investing industry, particularly in the UK, is that gatekeeping and complexity sell. I've spoken to so many people that feel they either need to have 20 plus holdings in their portfolio and they need to beat the market, or that they're too nervous or too concerned about the risks of the market, so instead they hold cash, which obviously has its own downsides, especially in the long run. But that's because we put this complexity on this pedestal. We feel that having one holding, could be a global ETF, is far too simple. And because that doesn't sell, the people making the money, the advisors, the platforms, there's no point in them just saying, have a really simplified approach. And of course, you can never cover all bases. You can't just say to everyone, I'll just invest into a global ETF and that's your problem solved, because everyone will have their unique issues and problems that they need to address. The access to information has never been more available, but that can work both ways. If anything, there's actually probably too much information. There's enough information out there for people to make an educated decision, but there's also too much out there that people feel overwhelmed, and then they just avoid it altogether. And when you combine that with the accessibility that comes from the platforms and the apps on your phone, where you can make a trade within a few seconds, it makes it so easy that when you're watching a video or reading an article and someone's talking about a fund or a company, it may feel like, oh, that sounds like a good idea. I can just add that to my portfolio. And before you know it, you could end up with a portfolio with 20 plus holdings. And that's exactly what these platforms want you to do. They want you to be trading regularly. And it's the same with advisors. They want to show that they're adding value. And that's because the boring approach doesn't sell. For a lot of people, investing is an afterthought. They'll invest whatever they have left at the end of the month. Especially if you earn a decent salary, it can be very easy to fall into the trap of feeling like money won't be an issue later in life. There's also a sense of, well, I've worked hard for this money, so I'm going to spend it while I still can and have some fun. And I do actually think that's a good thing. I think it's important to live while you're young. But at the same time, you do have to decide which part of your life is variable. Is it your future life, Or is it your restaurant bookings? When you pay yourself first, it means setting a fixed amount that you're going to save or invest every month. And then whatever you have left is what you're going to have for discretionary spending. And not only is that reinforcing good habits, but you're improving your consistency, and actually it'll make you more efficient with your spending in general. Getting the ball rolling with investing is such a hard thing to do, especially because you don't see the compounding returns. Getting to that first 10K invested or saved is such an important milestone. When you have just a few hundred or even just a few thousand saved or invested, you don't really see the compounding effect. I remember when I was in my 20s, I would save up to about 4,000 or 5,000, and I'd just go and spend it on a holiday. Because even though I might be getting good, decent returns, it wasn't really the monetary amount that was motivating me to keep continuing. So it was so tempting to spend it. But once you get above 10K, for example, you do start to see that compounding effect. A 10% annual growth rate is another £1,000 in your portfolio. And that motivation is really important because that's what's going to help you maintain and sustain that fixed amount on a monthly basis. It also means when you get a pay rise, rather than putting that on your discretionary spending, you're much more likely to want to put that into your investing because you're seeing the compounding effect. And it comes back to that point about not overcomplicating it. Keep it really simple, keep it boring, make it easy to manage. That's what's going to allow you to maintain the consistency and sustain this long term. We could go into a lot more detail about these things, but I wanted to keep this at a high level and just pick out the key things I think are important. But let me know your thoughts down below in the comments. Thanks for watching, and I'll catch you in the next one.